For months, the U.S. economy seemed perfectly balanced and entirely predictable for investors. Then, that stability violently tipped. Going into this year, investors broadly expected the Federal Reserve to finally ease monetary policy, lowering interest rates from their current restrictive range of 3.50 to 3.75%. Wall Street's baseline expectation anticipated rate cuts beginning in mid to late 2026. But now, major brokerages are throwing those predictions out entirely. BofA forecasts 0 cuts for 2026, while Goldman Sachs slides their initial expectation back to December or even March 2027. This sudden delay is injecting massive uncertainty into the stock market. Institutional money relies on predictable borrowing costs, and pushing those rate cuts back creates a severe mathematical headache for anyone modeling future corporate growth. To understand why the world's smartest forecasters got it wrong, we have to trace a chain reaction that starts far outside of Wall Street. The first major disruption originates with a conflict in the Middle East, now entering its 10th week. That ongoing geopolitical tension has directly driven up the global cost of raw energy and oil prices. This animated supply chain map demonstrates a concept known as a baseline multiplier. Energy is the underlying cost of almost everything. When crude oil gets expensive, it forces a cascading wave of price increases across all connected downstream nodes, like manufacturing and transport. Those elevated global costs eventually arrive at U.S. shores, filtering directly into everyday consumer goods and keeping domestic inflation stubbornly high. As long as raw energy remains expensive, it creates a firm floor on prices. The U.S. inflation rate simply cannot drop to the Federal Reserve's required 2% target while oil markets are pricing in conflict. Geopolitical tension is only half the equation. The other disruptor is happening domestically, creating an economic paradox where the U.S. economy is actually running too hot despite currently high interest rates. The April economic data showed employment growth easily beating expectations, while the overall unemployment rate held steady at a resilient 4.3%. This creates a unique economic friction. Strong, steady employment means millions of workers continue to bring home reliable paychecks, providing them with the capital to maintain high levels of consumer spending. That unbroken demand results in sticky inflation, prices that stay elevated simply because buyers are still willing and able to pay them. From a policy perspective, this completely removes the urgency to stimulate the economy with cheaper borrowing. What counts as excellent news for everyday workers securing steady jobs is the exact mechanism preventing Wall Street from getting its anticipated interest rate cuts. Geopolitical inflation and domestic economic resilience ultimately collide at a single pressure point: the U.S. Federal Reserve. The central bank is caught in a serious policy dilemma. They can't lower rates because of the clear upside risks to inflation, and the surprisingly strong labor market means there's no domestic emergency forcing their hand. This tension came to a head at their April 29th policy meeting, where policymakers ultimately decided to hold interest rates steady. This data visualization maps out the 12 voting members from that meeting, revealing a severe internal division. The sharp 8-4 split vote marks the closest fracture among policymakers on the committee since 1992. When the top economists in the country are historically divided on how to interpret the data, major brokerages realize the only logical move is to brace for a total policy freeze. The revised forecasts from BofA and Goldman Sachs are a direct mathematical reaction to the Federal Reserve's current paralysis. We are operating under a new economic reality where the data threshold required to trigger a rate cut has been raised significantly. For this freeze to end, the data has to decisively shift. We need to see either a firm stabilization in global energy markets or a measurable cooling in the domestic labor force. Until one of those two conditions is met, the era of expected easy money is suspended. Investors are now left to navigate a prolonged period defined by high borrowing costs